If you've ever wondered how real estate private equity firms structure their deals and how much money they make off of them, this is usually a highly guarded secret. Almost no one will give it to you straight, mainly because they don't want their investors to know. Today, I'm going to pull back the curtain and show you everything: the structure, the analysis, even how much money I stand to make. I just bought an $8 million deal a few weeks ago, and I'm going to walk you through the deal analysis, how I sourced it, how I structured it, and the part I'm sure you're most excited to hear about: how much money I anticipate on making in 3 to 5 years once the deal is sold. I think you'll be pretty surprised how much you can make on just an $8 million deal. I started a real estate private equity firm just over 3 years ago, and have since scaled to over $30 million AUM. If you'd like to learn more about what I do, like, subscribe, and turn on notifications, as I'll be releasing a lot more content over the next few months, showing you how you could do your own deals in real estate and even start your own real estate private equity firm. So how do deals like this happen? This deal first came across my plate in the beginning of the summer. A friend of mine who happens to be starting up a real estate private equity firm himself came to me with a problem. He had a lot of deal flow, but had trouble sourcing equity. I told him that maybe I could help. If he could send over the details, I would take a look. I took a look, and I loved what I saw. To give a brief overview of the deal, it's 105 units, major Sunbelt growth market, 1960s, 70s builds, a kind of a classic Class C value add story here. I have slightly anonymized the information here, so you won't be able to trace this deal back, but it's nothing material. So I'm going to start off by going into the capital stack. Then I'll get into the business plan, really why I like the deal, and then we can get into kind of the cash flow on the right side here. So the capital stack, purchase price $7.8 million, roughly 75 a key. Closing costs, financing costs, and renovation costs, which are roughly $9K a key. This isn't a really heavy lift. A lot of the units have already been renovated, so we're really just kind of addressing those that haven't. Overall, into it for around 88 a key, 9.2 million. As you can see here, roughly 55% of the capital stack is debt, 41%, 4.1 million of it is equity, right? So 45% or so. So really not that highly levered at all. And we're coming in at a pretty good yield here, if you look at it, right? Basically, NOI is 568K, coming in at basically 6.17 based on the total sources and uses. And if you just bring that up to the purchase price for the incoming cap rate, it's roughly 7.25. So that's very attractive. People were buying these deals for roughly 3 and 4 caps a few years ago. So that's obviously a very, very big difference. I mean, this deal, just to give an example, right, this at a 4 cap would be a very, very different valuation here. Right, that would be 14 million. So just to give you an idea of how much the difference in prices kind of people were paying a few years ago. And one of the reasons why I think this deal is so interesting. Right. So first reason why I think it's interesting is the low basis here. 88 a key all in is very low, and is very attractive. I think I'll get into the sale comps later on, but very attractive. Then you have kind of the incoming yield, right? Like I said, we're coming in at 7.25 once you kind of load in all the costs, roughly 6.2 stabilized yield. That's pretty attractive on product like this. Really, what I think is most interesting about the deal is where you can stabilize. And we're basically taking the rents from around $1,000 today. You'll see the rent roll in a second, kind of going up to $1,300. And I'd say rents right now are between $1,200 and $1,250. So there'd be a little bit of rent growth kind of baked in there. But it's a pretty simple business plan, just continuing you've renovated the units that the previous seller had already renovated. Renovating the units the previous seller hadn't renovated. So really not much going on with that. But that's the basic thesis of why this deal is interesting, right? And to give some background to the context in other markets, right? You have major Sunbelt markets. A lot of people aren't buying right now because of the supply that's coming in, right? And that's really one of the major 2 risks in the deal. And a lot of people aren't buying right now just because 1960s, 70s build, kind of Class C build, they're kind of staying away from a bit. So I do think there was kind of a moment in time here where we're able to scoop this deal up for a very, very attractive basis. Almost no one stabilizes to a 9, even trended. Even trended just means the rents are growing on this type of product in a Sunbelt market. Almost no one. So that's not guaranteed that we're going to do that. But if we do pull that off, it would be very, very good. Really, really a true home run deal. So the big thing here is the stabilized yield of 9% versus the exit cap rate of 6.5% here, which is a 250 basis point spread. Typically, anytime you get a 150 basis point spread, the deal is interesting. 200 basis point spread is what you're looking for. 250 is really great. The other thing that's great is really the exit cap rate, how conservative that is. That's at 6.5%. Very, very few people are underwriting exit cap rates that high. So the average person is probably underwriting exit cap rates between high 5s and 6 or so for this type of product in this type of Sunbelt market. So we're being very conservative there, and we have a very large spread, which is the most important part of any deal. It's really having a big spread between your stabilized yield and your exit cap rate. And then as you can see here, the disposition modeled at 6.5% exit cap rate. The sale price on 105 units gets us to roughly 123K a key. And as you can see, even that's not too high. We'll get into that more during the sale comps, but even that is a pretty attractive basis there for the next buyer. Let's get into the cash flow for a second. So the cash flow here, really the revenue is the major thing to talk about. When you talk revenue, you're really talking about the rent roll. You can see the rent roll here. And the units are pretty small, 450 square feet. You could see kind of the amount of units that are renovated versus unrenovated. You can see they've renovated quite a bit here, but definitely work left to be done. When you do look at the rent roll, and I'll just kind of scroll around randomly here, you can see kind of a lot of issues with how they've basically leased it up. You see that the unrenovated units are sometimes getting higher rent than the renovated units, even though the renovated units are actually signed up later. So you can see that there's mismanagement here, right? In that, why would you renovate? These leases were signed a month apart. Why would you renovate if you're getting lower rents on the renovated versus unrenovated? Obviously, they're either one, not pushing rents correctly, two, not doing the correct renovations, or three, and this could be a problem for us, right? And something you need diligence, the renovations don't actually add any value to the property. So overall, you can see when you kind of look at a rent roll like this, that there's been mismanagement, that they don't really know what they're doing. And I've kind of talked about this in previous videos, but overall, the current kind of average rents right now are just under 1,000, $999, right? We're going to bump them a little year one, and then really just bump them gradually and renovate gradually. So it's not a crazy business plan here. You can see kind of the growth really is pretty slow as you travel forward. And there's not much to this. This is a pretty simple business plan. There's not that much risk involved, right? It's not like we're kind of coming in a really low in-place yield and have to just really do all the renovations quickly to get it to where it needs to be. We can do these over time. We are considering maybe doing a refinance year 3, but that's not integral to the business plan. And the overall risk is kind of muted because we can kind of spread it out over time. The rest of the revenue kind of is what it is. We have modeled a fair amount of vacancy here, some bad debt. Obviously, when you have Class C apartment buildings, you need to be a little cautious. Parking income, and then fee income, which is made up of all miscellaneous fees that are being billed back. When you get down here to the expenses, you can see this is a pretty heavy expense load. The NOI margin here, right, you can see is roughly 50% or so, which is most people would be putting in kind of less than that, and really would have an NOI margin kind of in the 50 to 60% range for this asset most likely. So we're being pretty conservative here. This is a pretty heavy load. The only thing you'll see that really drops the utilities. That's actually we're going to kind of save on water. There's been an issue with the way they've been handling the water on the property. So we're going with kind of a water utility plan to do that and address that. So there's some savings there on the utilities, but you can see it kind of comes back up later on. Everything else here is pretty standard. There's not much going on with it. Management this is going to be third-party managed. They basically make 3%. That's their fee. And then their employees are just billed back to the property. So that's the payroll there. So this is basically the third-party management company's compensation for the deal itself. Then deal, like I said, it's in Sunbelt, Texas, actually. So Texas franchise tax here. And then we just have replacement reserves and asset management fees. Overall, this gets us to a pretty attractive cash flow on the in-place. You can see that the debt service here, right? The NOI divided by the debt service here gets you your DSCR. It's pretty attractive. We're coming in at like a 2. So that's difficult to do on most deals and just shows you kind of how relatively safe a deal like this is. Before I get into the returns on this deal, I want to talk about the acquisitions bootcamp. If you're a beginner in real estate and don't know where to start, or if you've been in real estate for a bit but are struggling to scale, this program is probably a good fit for you. We've helped clients buy 600K multifamily deals. We've helped clients buy 13,000 square foot industrial deals. We've helped clients buy their first deal ever. And we've even helped clients scale and make $1.5 million on a deal in just about a year. I'll probably make a video about that incredible deal soon. It's something I'm passionate about and like doing, and there's genuinely no other program like it in the world. I truly believe that. If you're interested in making real money in real estate, you can set up a call to discuss joining the program in the link in the description of this video. As a heads up, it's a one-on-one program with me and my business partner, so spots are limited. Something I want to talk about for a second here are the risks in the deal. To give some reminder context here, right? This is a 1960s, 70s build in a major Sunbelt market. And when you think those two things, there are typically two major risks that come up. One, and the first one we'll get into, is supply, right? So a lot of these Sunbelt markets have had a lot of supply coming in over the last year and will have it for the next year or two. So that's definitely something to take a look at, and definitely something we looked at in our underwriting. For this deal specifically, this did happen to be, and this is one of the reasons why I wanted to do the deal, it happened to be in a submarket that has pretty much no new supply coming in and has had pretty much no new supply coming in over the last 2 years. So it's relatively insulated, even though the market itself has had a supply issue and will have it for the next year or two. I really think that's one of those things that once you wait it out, the market will recover. These are growth markets and do have a lot of population coming in anyway. But it is something to monitor, right? The other thing I would say that helps us out on the supply side here is actually the unit size. And I think this is a bit counterintuitive. Most people don't think about it this way. But when you have units that are this small, this is kind of 400 to 500 square foot unit size, right? You can see in the rent roll there. You're typically the lowest price point. And I think a lot of people view that as a negative, right? Because you're smaller compared to your competitors, which is true, but you also cost less than them, right? So let's say all the other rents in the market, I'm just going to make up a number here, at 1,200, right? And you're currently at 1,000. You can really keep raising rents until you get to the competitors, right? Because people don't really have a choice aside from you. You're the last resort. And you actually do have a lot of pricing power here. I've had this happen before on deals. I had one deal that I sold out of that the units were actually smaller than 400 square feet. They were like 385 square feet. And no one wanted to buy the deal because they thought the units were too small. Meanwhile, you have so much pricing power because you can keep raising until you hit the next competitor. So I think a lot of times these smaller unit deals actually have a lot of pricing power, and people kind of make a mistake by looking at it on a square foot basis and saying, okay, the comps do blah, blah, blah. And you're not going to hit the comps, right? But you don't need to hit the comps. You can keep raising rents until you're just below them, and then you're still a more attractive option than them because you're cheaper and people need to live somewhere, right? It sounds cliche, but it's true. So that's also another thing that really, I think, helps this deal on the supply side. It's really the fact that, one, the submarket itself is insulated, and two, when you're relatively cheaper than everyone else because of kind of the smaller unit size, you actually have some pricing power when other people won't. So just something to think about there. I've never really heard anyone else articulate that, but I've seen that happen a few times in my career. And that's something that I hope will happen on this deal, which I think it will. The other major risk in the deal, once again, 1960s, 70s build, is CapEx and repairs and maintenance, right? So that's something that we looked at closely here. I know when you look at it face value, it doesn't look like we allocated much here. That's actually because part of this payroll is a full-time repairs and maintenance guy. So we've actually allocated a lot. You see turnover, make ready, repairs and maintenance, full-time R&M guy here. And we actually have 25K in replacement reserves as well below the line. So we're allocating over 1,000 a unit here, which is actually a fair amount. You look at what most people are allocating kind of in the run up who got in trouble on these type of deals, and it was well below that, usually in the 500 or so a unit range. So we're well above that. We acknowledge that this is definitely a risk in the deal, and that's why we wanted to underwrite appropriately there. So that's really, between those two, I would say the two biggest risks in the deal. I'm not going to say there are no other risks, but those are really the two biggest risks. And that's how you try and mitigate them, is right? You try and find ways to kind of alleviate part of the risk. You're never going to get rid of it fully, but you can really try and get ahead of it. And that's what we tried to do here. All right, so there are basically 3 ways to value real estate. We've already gone over the first in the simplified model here, and that's the income approach. The other 2 approaches are the sales comp approach and the cost approach. And both of those can be done using sales comps. You can see here I laid out kind of all the sales comps we could find in the market from 2021 to 2024 for this asset. And I really didn't cherry pick these. These are every single comp I could find that was applicable. As you can see, we're coming a significant basis to the average here. And the average isn't always the best number to look at because they're obviously outliers like this here and kind of lower numbers like this kind of here, right? But overall, the average is 138K unit. And we're stable. We're coming in, we're buying for 74 unit, we're stabilizing at 88K unit, right? And really why that's important is for a few reasons. One, if you look at it from the cost-driven approach, right, it typically costs in almost every city in the country, even if you get the land for free, at least 180 to 200K a key to develop brand new. So we're coming in at a very, very big discount to that at 88K a key, and the sales comps are even at a very big discount to that. So we're really not in a huge danger of being kind of impacted by new supply. This market itself does have new supply and kind of class A rents that are different than the rents we're seeing here. But overall, we're at a significant discount to that. We're not competing with that product, right? If we were coming up kind of closer to 200K a key, it would be way more of an issue, right? And that's not the case here. So overall, from a cost-driven approach, it's a significant discount to what it would be to build brand new, which would be at probably around 200K a key, if not more. I would say most people build for 200K to 250K a key. So significant discount to that. So that's obviously a good thing. The next thing really looking at is just the sales comps themselves. And the way I look at it, when you have a true home run deal, basically what that means to me is, one, obviously your stabilized yield is really good. But two, when you look at the sales comps, basically you're not only you buying for below the current market basis, right? In which case we're basically buying for 88K a key here. We're stabilizing for 88K a key. We're also selling for below that. So when we sell eventually here, right, this sale price, right, divide that by the 105 units, that's only 123K a key. So we're selling for in 3 to 5 years from now, right? We're selling for less than what the average deal is really going for today. So that's one of the signs of a very, very good deal. And what it means is that the person who buys from us is even going to make money, right? They have a profit margin themselves. And you always want to be thinking about kind of the end buyer there, because it's very important, right? If you want liquidity, you need to sell to someone. So obviously the deal needs to be attractive for the next buyer too. And that's really what you're saying here is not only is the deal attractive for you at your 88K a key basis compared to the 138K a key, but it's attractive for the next buyer at 123K a key basis and the 138K a key market basis, right? So it's attractive to the next buyer too, which makes it, this means this deal has a lot of margin, right? And it means there are a lot of people who'll be willing to buy. And when they buy, they're still going to be significantly below replacement cost. So all of that is very, very important and makes it very attractive as a deal. That's really something that's pretty important here. And obviously, I think stabilized yield is always more important than the basis. But one of the biggest signs I see of a deal that is a home run deal is what I was saying here, where you're selling your exit price 3 to 5 years from now is below the current market basis. That is by far probably the second biggest indicator aside from stabilized yield of having a home run deal. And look, you never know exactly how a deal is going to turn out. Obviously, there are things that can come up along the way, but it's a very, very good indicator. Another thing I want to point out here is the run up kind of from 2021 to 2022, which was really the peak of the market. And you could see here, people were buying for 175 a key. Obviously, this is on a slightly different asset and everything like that. But overall, prices really got inflated then and they started coming back down. You can kind of see it trend back down a bit, really towards kind of an average of, let's call it 130 key here, roughly around there. So some people definitely got swallowed up in this market. People who bought here and here, really here, here, and here probably aren't going to do too well. And else is most likely going to be fine. So there is that run up there. That's definitely affecting the average a bit. I still think the average should be around 130 a key or so. And even if you say it's 115, which is the lowest sale in this entire comp set, we're still significantly below that on our basis, and we're just above that 3 to 5 years from now on our sale. So that's kind of how you analyze sales comps, and this is why I think this deal is extremely, extremely attractive. All right, this is the moment everyone's been waiting for. How much money are we going to make on this deal? So for those of you who don't know, this is a waterfall structure here, this whole tab. I'm not getting into specifics. It gets very, very detailed, but basically it's a series of cash flows kind of laying out how the returns are paid out in a private equity or syndicated deal. And there are tiers to that. I'll explain that in a second. But basically how this deal was structured was 20% of the equity was GP equity and 80% was LP equity. So basically 850K came from GPs, and this is a joint venture, remember? So there's 2 different general partners in it, and the rest came from LPs. That's high. Normally I would say it's GPs are putting in 5 to 10% of the equity. This does include rolled in acquisition fees as well, but it's still very high, which just shows their dedication to the deal. Obviously, you can't do that on every single deal. You'd like to. But as you get bigger and bigger and bigger, it's hard to roll in 20% of equity into every deal just because you start running out of money at a certain point. But this deal, we were able to put in a fair amount of money, which is great for us. It's a deal we really believe in. And that obviously made our LPs happy as well. So the way the promote is structured here is it's 20% over a 9% IRR and then 30% over a 13. So that's kind of our returns. We're also getting paid an asset management fee that's roughly $25K a year, so across 5 years. And we also had an acquisition fee that was rolled in. So our portion of the acquisition fee was roughly $200K. Our portion of it was 50%, because obviously it's split in half. So we basically put in 550 by ourselves. And basically, this is the total GP stake, by the way, right here. And this is our GP stake specifically after the 50% split, just to clear that up. But we basically got a 100K acquisition fee. And before I get into kind of showing how much money we're going to make in the deal, which you can kind of see here, what I want to point out is if this deal doesn't do well, we've committed 550K of our own capital to it. We've worked for 3 to 5 years on it. Our only return is 63 grand of AM fees and the 100K acquisition fee we rolled in. So I know everyone gets on general partners and real estate private equity firms and private equity firms for charging really high fees. I don't think they realize the work that goes into it. We could easily, if we do a bad deal, be working for 5 years and essentially not make any money at all. So just something to point out there. Obviously, we do make money if the deal does do well, but we're also putting in a lot of money ourselves. And typically, not in this deal at agency debt, but typically we're guaranteed on the loan. So there's a lot of risk that goes into it. Returns are obviously not guaranteed. None of these returns are guaranteed. But if they do well and everything pans out, we're going to make a fair amount of money on the deal. So basically, the deal level return should be roughly 25% IRR, 2.3x equity multiple in 5 years, total profit of just over 5 mil. So basically putting in 4.1 mil of equity, getting out total proceeds of roughly 9.3. LPs are diluted a bit because of the promote here and the other fees, but they still end up with a pretty decent IRR, pretty decent multiple, and pretty decent profit here. So when this deal does pay out, or if it does pay out, right, we'll have our promote, which this is the full promote here is 1.1 mil. Obviously nothing really crazy there. And on some of these smaller deals, and 8 million is still a smaller deal, you make a lot of your money based on the equity you're putting in. So we put in this 850K of equity. Like I said, some of that is the acquisition fee, but a lot of it's our own money. And you make money on that return right here. You can see you're basically getting your LP return of roughly 2x on that 850K. So that's driving more of it than the actual promote. Just something I want to point out there too. It's not like all this money you're getting for free. You're putting in money here to make money. And then you get your AM fees as well. So the total kind of GP profit here is going to be just under $3 million. You have your promote, which is basically determined by these tiers of the waterfall here. Then you have your return on the capital committed. Then you have your AM fees, right? That's really it. So $3 million, obviously that's good money. When you talk about 3 to 5 year hold here, right now we have it modeled as 5. And then that gets split up afterward because this is a joint venture. So we're not getting all the money, right? We're basically splitting it in half. And for the promote, we're splitting that completely in half. So we just make roughly over 500K there. Then we have our capital committed. We put in, like I said, roughly 550, then 100K acquisition fee. So 650 that got rolled in. We didn't even take that money out at all. So we rolled it into the deal, just showing you how much we believe in the deal. That gets you a $1.3 million return just on the 650K put in. Then you have the promote, then you have the AM fees. So we should receive a check for roughly $2 million when this is all said and done, which is a pretty good return, right? This deal doesn't have that much risk really. We're coming in at a relatively high cap rate. And basically what we're doing is we're roughly 3xing our money, right? Roughly 3xing our money in 5 years with, I think, not that much risk. So obviously that's not guaranteed, but that's the type of money you can expect to make on a deal like this. That's even a relatively small deal. $8 million is a relatively small deal. So obviously as you get bigger, that number goes way up. Really the number that goes way up is the promote here and here. Once you get bigger, and you're probably not investing that much more capital because like I said, they're just scale issues at a certain point. But overall, $2 million on a joint venture on a deal that doesn't have that much risk over 3 to 5 years is really a very, very good return. And that's kind of what we would be targeting to get out of the deal by the end of it.
If you don't know, the Acquisitions Bootcamp is an 8-week program where you work one-on-one with me to craft an investment strategy to fit your skills, resources, and goals, and then find you a deal to fit that strategy. So it's for beginners and owners looking to scale. If you're interested in that, you can apply to that below.